Hello everyone and welcome back to another video. In today's video, we are going to be going through Mercado Libre's most recent earnings report, and I will be explaining why I have been adding to this position so much over the past couple of months now. Then we are going to go through Palantir's earnings report that they just announced yesterday, because the stock is falling after this earnings report, and I want to explain why, and also the highlights and lowlights from Palantir's earnings. And then lastly, we are going to be discussing the new shorts that Michael Burry is doing, because they are quite shocking. This is going to be another action-packed video, but before we get into it, I want to let you all know that I am going to be offering a Black Friday sale on my new 30-plus hour-long investment course. So if you have been thinking about getting my new investment course, then I would wait until the Black Friday sale so that you can save some money. Also, if you want to be notified when my Black Friday sale goes live, then you can head over to my website, www.danielpronk.com/course sale. And here you can join my email list so that you can get notified when the sale goes live. I will also put a link at the top of the description so that you can easily find this page. And all you have to do is enter in your email, and then you will get notified when my sale goes live. And I just wanted to make this crystal clear because I don't want anyone going and buying it right now and then feeling bad that you could have saved some money buying it in a couple of weeks. I've done that before, it feels bad, and I don't want you to go through that. So with that being said, let's now hop into the video, and let's start off by taking a look at Mercado Libre's most recent earnings report. And as always, I took screenshots of all of the highlights that I think investors need to know. So right here, we can see that for the third quarter of 2025, Mercado Libre's gross merchandise volume increased by 28% year over year to $16.5 billion. Items sold increased by 39% year over year. Total payment volume in their fintech business increased by 41% year over year. Their credit portfolio within the fintech business increased by 83% year over year, so it almost doubled. Net revenues increased by 39%, income from operations had a roughly 10% margin, and net income had a 5.7% margin. Now, initially, Mercado Libre stock did fall after they reported their earnings, and I think it's because the margins were compressed a little bit in this quarter. But if you have been following my channel for some time, then you know that I was expecting this because Mercado Libre lowered their free shipping threshold in this quarter. And this was the first quarter where that lower free shipping threshold was applied for the entire quarter. The thesis on the management is that by lowering the free shipping threshold, they would accelerate growth in gross merchandise volume, revenues, items shipped, and people signing up and going on Mercado Libre's e-commerce platform. So let's see if that ultimately played out. Well, right here, we can see that unique active buyers growth accelerated to 26% year over year. In Brazil, our decision to lower the free shipping threshold led to the highest quarterly addition of unique buyers in our history. And in this chart, we can see that there were 76.8 million unique active buyers on Mercado Libre's marketplace in the third quarter of 2025, with that 26% year-over-year growth, which was the highest growth rate, which is clearly an acceleration over the past year. And this is even more impressive because Mercado Libre is seeing accelerated growth on an even higher base. And overall, I think that this is a great thing to see. Now, on their next slide, we can see that items sold increased by 39% year over year, which was an acceleration from the second quarter of 2025 and the third quarter of 2024. So the number of items being sold on Mercado Libre's e-commerce platform is accelerating, and I do think that this is partially due to there being more free shipping on more items now. Additionally, this next slide shows us that the items sold per unique buyer increased by 11% year over year and hit a new all-time high, with 8.3 items being sold per unique buyer on the platform. So not only are more people buying on Mercado Libre's platform, but each person is buying more as well. And this is causing a significant amount of growth for the business overall. Now, moving on to the fintech business, we can see that fintech monthly active users hit a new all-time high of 72.2 million, increasing by 29% year over year, which is very strong growth. However, in the fintech business, we can see that the growth rates are slowly decelerating, which I do think is fair, simply due to the law of large numbers. As the base continues to grow, it is more and more challenging to maintain extremely high growth rates. But overall, I still think a 29% year over year growth rate to their fintech monthly active users is very strong. Moving on to the next slide, this one shows us more KPIs from their fintech business. And here we can see that their assets under management increased by 89% year over year. And here we can see once again that the credit portfolio increased by 83% year over year, And the credit portfolio also grew by 17% quarter over quarter. That is very impressive growth. And the credit portfolio is where a lot of Mercado Libre's free cash flow is going to. They are plowing billions of dollars into growing their credit portfolio, and this very much so is one of the focuses of the business going forward. Moving on to the next slide, this one gives us a great overview of all of the different growth rates to Mercado Libre's overall business and its different business units and geographies. So here we can see gross merchandise volume on an FX neutral basis grew by 35%, items sold increased by 39%, live listings are up 37%, total payment volume on an FX neutral basis is up 54%, total payment volume in fintech services is up 71.7%. The credit portfolio in terms of US dollars is up 83%. Credit card portfolio is up 105%, so it more than doubled. The consumer credit portfolio is up 71%, and their merchant portfolio is up 61%. Unique active buyers on the Mercado Libre e-commerce platform are up 26%, and fintech monthly active users are up 29%. Now, in terms of geography, we can see that Brazil grew by 37.6%, Argentina is up 39.5%, Mexico is up 44.2%, and the other countries are up 39.4%. So Mexico had a very strong quarter, and it is Mercado Libre's second largest market. On a consolidated basis, they did $7.4 billion of revenue for the quarter, which is up 39.5% year over year. So all around, this was a fantastic quarter for Mercado Libre, and they're growing their revenues by nearly 40% year over year, despite them producing over $7.4 billion in quarterly revenue. This company is just absolutely insane. All right, let's now move on to the shareholder letter, and I want to show you the highlights that I found here. So this says, our net revenue and financial income grew 39% year over year in the third quarter, the 27th consecutive quarter of growth above 30% year over year. During this 7-year period, market share and net promoter score data show that we have significantly strengthened our competitive position across our businesses, while margins and cash flow have improved markedly. So Mercado Libre has produced more than 30% year-over-year growth rates for 27 quarters straight now. And I actually saw a post on X that said something along the lines of, Mercado Libre is the only business in the stock market that has produced this level of revenue growth for this long. There is no other business that has grown over 30% consistently back to back for 27 quarters straight. This business is, again, it is absolutely ridiculous. Moving on, Mercado Libre then says, unique buyers in Brazil grew 29% year over year for the third quarter, the fastest pace since the first quarter of 2021, and the largest quarterly addition of unique buyers ever, surpassing even the pandemic peak. Sold items growth in Brazil accelerated to 42% year over year, and FX neutral gross merchandise volume also accelerated, rising 34% year over year. Market share gains accelerated, and our net promoter score reached its highest level ever. The number of merchants making sales in the R19 to 79 range grew at double-digit year-over-year pace in the third quarter, while new listings in the range grew 3x year-over-year. Conversion reached an all-time high, and retention hit record levels for new and existing customers. So I think that it's pretty clear that by Mercado Libre lowering its free shipping thresholds in the past quarter, they have seen an acceleration to their overall growth. They have taken market share, attracted more buyers to the platform, attracted more sellers to the platform, and overall, it seems like customers are happier with Mercado Libre as well. This seems to be the right move for the business over the long term, and it is strengthening their competitive advantage at the cost of some short-term margin compression. So for me, as a long-term investor who is not focused on the short-term profitability of this business, I think that they're making the right moves that are going to grow the business's intrinsic value the most over the coming decades. Continuing on through their shareholder letter, I have the third quarter of 2025 growth rates highlighted here, and the third quarter of 2024 growth rates highlighted on the left side. This is to give us an easy view of the growth rates that Mercado Libre was seeing in the third quarter last year versus the third quarter of this year to see which businesses are accelerating and if the overall business is accelerating as well. And here we can see that Mercado Libre's Argentina revenues accelerated to 39% growth versus 14% last year. The fintech business also saw 49% growth this year versus 21% last year, And for Mercado Libre as a whole, revenues accelerated to 39% growth this year versus 35% growth last year in the third quarter. So Mercado Libre is not only maintaining 30% plus growth rates, but their revenue growth rates are also seeing acceleration year over year. Gross merchandise volume in both Brazil and Mexico also accelerated strongly year over year, which led to the total gross merchandise volume for the business also accelerating and seeing double the growth rate that it saw last year. Total payment volume and total acquiring volume also saw strong acceleration year over year. So Mercado Libre's flywheels are continuing to exist, and the business is actually seeing accelerated growth even as it continues to scale. Let's move on to the transcript from the conference call, though, and I only have one final screenshot to share here. So here, the management said, "We are not managing the business for short term margin. We are managing for long term value creation. We think that if we continue to sustain the levels of growth that we are delivering, we are on the right track. As we have said in the past, we are not going to hesitate to invest behind that, even if it puts some short term margin pressure. In the long term, we continue to be very optimistic about the margin profile of our business. As we continue to scale the business, and as some of the investments that we're making continue to mature, such as the case of our credit card, our 1P investment, and many other things that we're doing throughout the ecosystem. This is partly why I like Mercado Libre's business so much, is because they are one of the few companies that is willing to sacrifice short-term margins, maybe put some pressure on profits today, to do what is right for the long term of the business. And what's funny is every time Mercado Libre does this and they make it clear that they're investing in some growth, investing in the business, and trying to increase their competitive positioning, the market tends to react poorly because analysts seem to be focused on the quarter to quarter results in terms of the net profit margin. Or, in other words, analysts seem to be focused on the profits of the business from quarter to quarter, when Mercado Libre's management is not focused on that metric at all. Again, they are very happy to lower the margins in the short term to increase the competitive positioning over the long term and ultimately make the business as strong and as successful as it can possibly be for the long term. And as someone who is a long-term investor, that is why I like this business so much. Now, very quickly, let's take a look at some of Mercado Libre's financials because I want to show you how ridiculous this is. So right here, at the beginning of 2020, Mercado Libre was producing $2.5 billion in revenue. And now, as of the most recent quarter, they were doing $26 billion of revenue. So Mercado Libre has 10x'd its revenue since 2025, and its revenue growth rates, once again, are accelerating right now. This business is phenomenal, and I have never seen a company with a growth track record like this. In my opinion, Mercado Libre is also producing somewhere around $5.3 billion in trailing 12 months free cash flow now. Their cash flow statement is very noisy, and it emphasizes their free cash flow due to their credit portfolio and them being more of a fintech-like business now. But their true profit potential, in my opinion, is around $5.3 billion. So the company's market cap today is $118 billion. So if we divide that by the profit potential of the company, then it means that they're trading for about 22.2 times free cash flow potential today. And for a business that is so high quality, growing roughly 40% year over year, and they have such a long track record ahead of them, I think that this is a very fair price. And this is also why I have continued to buy much more Mercado Libre in my own portfolio, and it's actually one of the largest positions in my portfolio now. I think the market is focusing too much on the short-term margin compression, and they're not focusing on the long-term fundamental opportunity here. And I think that when we take a look at Mercado Libre and where the business is, even within the next 5 years, today's price is going to look like a steal. If this business can continue to maintain these growth rates, or even if they see their growth rates decelerate to the 20% level, I still think that the price today is very compelling, and that's why it has become one of the largest positions in my portfolio. All right, let's now discuss Palantir's earnings results and why the stock is down 8% on the day, and it looks like it's now down 1.3% in after-hours trading as well. I do just want to apologize in advance if you hear any weird noises through my mic. My cat, Tuna, has decided that he wants to come and hang out with me right now and is demanding cuddles, and he likes to touch the microphone when he's here. So if you hear any of that, I do apologize. Let's hop into Palantir now. And I did take some screenshots from its earnings, and straight up, Palantir's results were absolutely incredible. This company's fundamentals are insane. I am very impressed with this business, and I want to make that clear. Palantir's actual fundamentals are very strong and seeing accelerated growth, kind of like Mercado Libre. Here we can see that Palantir's US revenue grew 77% year over year and 20% quarter over quarter to $883 million. US commercial revenues grew 121% year over year and 29% quarter over quarter to 397 million. US government revenue grew 52% year over year and 14% quarter over quarter to 486 million. So Palantir's US business is absolutely exploding. I mean, their US commercial revenue literally more than doubled year over year and is up roughly 30% quarter over quarter. That is insane. Then they say that they closed a record-setting $2.76 billion of total contract value, up 151% year over year. So the total amount of contract value that they have also more than doubled. US commercial remaining deal value of 3.63 billion, up 200% year over year and 30% quarter over quarter. Customer count also grew by 45% year over year and 7% quarter over quarter. And then they say that they had cash from operations of $508 million, representing a 43% margin. So Palantir's results all around were phenomenal. This is the best earnings report that I have seen so far in this earnings season. We're not quite done earnings season, but straight up, I would be surprised if any other company has a better report than Palantir. And I genuinely mean that. This report was freaking insane. In this next screenshot, Palantir gives us their outlook for the fourth quarter, and they are expecting revenue of about 1.33 billion, which would be growth of 61% year over year in the next quarter. So it seems like Palantir is expecting this ridiculously high growth rates of around 60% to be maintained into the fourth quarter. For the full year of 2025, they are raising their revenue guidance to about 4.4 billion. And then they also say we are raising our adjusted free cash flow guidance to between 1.9 and 2.1 billion, which means that Palantir is basically expecting to produce $2 billion in free cash flow for this year, which would also put their free cash flow margin somewhere around 45 to 46%, which is a ridiculous profit margin. So not only is Palantir projecting to grow over 60% in the next quarter, but they also have profit margins that are insanely high. So it's a very profitable business that's also growing quickly and seeing accelerated growth. Let's now move on to Palantir's presentation for the third quarter. And here they show the rule of 40 enterprise software companies with over $1 billion in trailing 12 months revenue. And then Palantir shows us that their rule of 40 score is 114. For those of you who may not know, the rule of 40 score is the company's profit margin plus its revenue growth rates. So since Palantir is a very profitable business with profit margins in the 40% range, and it's growing over 60% year over year now, that puts its rule of 40 score at 114. And based on this chart, we can see that there's no company that really comes close to Palantir in the software space. The next company I would say is PTC with a rule of 40 score of 65. And also, again, for those of you who may not know, it's typically considered that if a company has a rule of 40 score above 40, then that is considered good. So the higher the score, obviously, the better it is for the company. And Palantir is in a league of its own. So the company is seriously performing incredibly well. Palantir then shows us their rule of 40 score versus the top 25 market cap companies globally. And we can see that they do have some more competition here, with NVIDIA actually better at 120. And then we also have Lilly at 102 and TSM at 81. So these companies right here have the highest rule of 40 score out of the top 25 companies globally. But even still, Palantir is only lagging behind NVIDIA. And this is a very impressive metric. Moving on, here we can see that Palantir's customer count increased by 45% year over year. And the other reason why I wanted to show this screenshot is because quarter over quarter, they increased their customer count by 7%, which was the lowest growth rate over the past year. But despite Palantir's customer count seeing some deceleration quarter over quarter, their revenue is still accelerating, which the only conclusion can be that their revenue per customer is growing significantly. Let's now go and take a look at some of Palantir's fundamental metrics. And here we can see that their revenue in the trailing 12 months is now at 3.9 billion, and you can clearly see that their revenue growth rates are accelerating in the trailing 12 months. If we turn this on to quarterly, we can see this is even more dramatic, and their revenue growth is nothing short of incredible. Palantir's trailing 12 months free cash flows are now sitting at roughly 1.8 billion and are hitting a fresh all-time high. This also puts Palantir's free cash flow margin at 46% in the trailing 12 months, which is a very high free cash flow margin. Now, the only thing that I do not like about Palantir's cash flow statement is that they do quite a bit of stock-based compensation at $770-ish million, which is roughly 40% of the overall free cash flow. So there is a lot of stock-based compensation going on. But what I'm also noticing is that Palantir's free cash flows are growing faster than the stock-based compensation. And if this trend continues, then the stock-based compensation could become less and less relevant over time. And this quick chart that I just made kind of shows that. So back here in the second quarter of 2023, Palantir produced trailing 12 months free cash flow of roughly 375 million, and their stock-based compensation was $500 million. So stock-based compensation was actually higher than their free cash flow at this time. And if we fast forward to today, the company is now doing 1.8 billion in free cash flow, and stock-based compensation is 770 million. And you can clearly see that the free cash flows are scaling much more rapidly than the stock-based compensation. And I would expect this trend to continue, and if it does, then the stock-based compensation will become less and less relevant, as I have just said. So once again, Palantir's results were absolutely fantastic, and the best results that I have seen in this entire earnings season so far. So then the question is, why is the stock down 8% on the day, and why is it selling off from its all-time highs? And in my opinion, it's simply because all of this incredible fundamental growth was already priced in and more. Palantir stock is in a realm of its own. I have never seen a stock outside of the very speculative early stage quantum computing companies that have price multiples like Palantir. I think that this is brand new territory for the entire market. For example, even after this strong earnings report and Palantir stock seeing a slight correction, its price to sales ratio is still 115. Its price to free cash flow ratio is also sitting at 250. These are massive, massive multiples to pay for any business. I don't care how fundamentally sound and strong the business is. These multiples are they're in a territory of their own. And I am an investor who believes heavily in focusing on the valuation and making sure that you are getting a fair price for any business that you're buying. Or to put that another way, you could have the highest quality, most fundamentally sound business the world has ever seen, but I still believe that business would not be worth paying an infinite price for, which ultimately means that there is a ceiling that all investors should be willing to pay for any business, again, even if it's the highest quality business the world has ever seen. But when it comes to Palantir, I think that the thought of valuation and price has been completely thrown out of the window. Like, for example, when you have a stock trading for over 100 times sales, that means that if all of the revenue could be converted into free cash flow, you would still be paying 100 times free cash flows, which is less than a 1% free cash flow yield on your going in price. That ultimately means that you're paying for a significant amount of the business's future growth. Because I think all of us investors watching this video, no matter who you are, can agree that a 1% yield on any investment, that's how much you would be getting from the business's cash flows versus the price you pay for it, is not attractive. It is unacceptable. No one wants a 1% return on their investment every single year. But again, relative to Palantir's price today, that is what the free cash flow, well, actually, the free cash flow yield is only 0.4%. But even if all of the revenue was converted to free cash flow, then you would be getting that 1% yield from the business today. And what that ultimately means is that the price you're paying is factoring in that the free cash flow will grow significantly, which will result in your free cash flow yield on cost also growing significantly. So now let's go back to real terms. Palantir is trading for 250 times free cash flow today, which, as we can see, is a 0.4% free cash flow yield. What this means is that even if Palantir 10x's its free cash flows from here, you would still only have a 4% free cash flow yield on the cost of your shares today. And that is after the business 10x's its free cash flows to $20 billion. That is pricing in way too much growth for my style personally. And every time I make a video on Palantir, I get multiple comments saying, I'm just fed up because I missed out on Palantir. I missed the run. and I haven't benefited from this business and its stock price doing so well. And that's the truth. You guys are right. I have missed out on Palantir. I have not made any money on this stock, and I've watched it just continue to run without me. And that's fine with me because it comes back to knowing what is your investment strategy, what you are comfortable doing in your own portfolio, and staying within your circle of competence. And at the end of the day, achieving your own goals. I have said this on my channel before, but my goal as an investor is not to hit the 10 baggers. I'm not even looking for stocks that could 10x over the next year. It's not in my wheelhouse, and it's just not what I want to do in my portfolio. Because I think that for every Palantir, there's hundreds, if not thousands of stocks that don't work out and people can lose a lot of money on. But for me and for my own goals, I am looking to make roughly 15% per year over the long term. Because if I can achieve that, I know that sounds ridiculously low in this current market, but if I can consistently achieve that over the long term, then that's all I need to retire extremely, extremely wealthy. And that is based on my own goals as an investor and the level of risks that I want to take with my portfolio. Because at this point, my portfolio is what my family's future is riding on. I don't know if I've shared this with my YouTube channel before, but my family is not wealthy. I am the wealthiest person in my family by far. Like, I won't get into that right now. But what I want to do is consistently grow my wealth, grow my businesses so that eventually I can use my portfolio and the money that I've made to not only support my immediate family, my wife, my future kids, but also to support my mom, help her retire, and make it so that my family can stop worrying about money for once. And when I have this goal and when that is my mission, that is why I have this YouTube channel, that's why I work so freaking hard, it's not worth it for me to risk my portfolio on things that I think look more speculative. And the consequence of that being my personal investment goal is once again that I am going to miss out on companies and stocks like Palantir, Nvidia, Robinhood, etc. And I'm happy with that. And I'm okay with that. And I'm also extremely happy for everyone who has nailed Palantir and made a lot of money. I think in the financial space, you know, just because someone is making a lot of money on something that you maybe missed or didn't buy, you don't have to feel bad about that. I think at the end of the day, as long as we're winning and people are making money in their portfolios, even if it's not the same strategy as you can still be happy for people. And I am genuinely happy for everyone who has nailed it on Palantir. I have someone in my Patreon community, Sandeep. Guy freaking kills it, man. He has bought like every stock that has gone nuts over the past 3 years. And I am genuinely so freaking stoked for him because I've watched his portfolio go from 1 million to something like $6 million now in a couple of years. So if you nailed Palantir, congratulations to you. Genuinely, like congratulations. But for me, I think that there is so much future growth priced into the stock that it increases the amount of risk significantly. And that's why I think the stock is down today, even after phenomenal results, and also why I'm definitely not buying into it now. I actually ran a discounted cash flow calculation on Palantir to show you what the stock is pricing in today. So I projected out Palantir's free cash flow over the next 5 years, and I said that Palantir is going to grow its free cash flows by 50% annually over the next 5 years, which is a very high growth rate, okay, to maintain over 5 years. I also said that over the next 5 years, Palantir will still be trading for an 80 price to free cash flow multiple, which I think is still very expensive, by the way. And in this scenario, to recap, if Palantir can compound free cash flows by 50% annually and maintain a price to free cash flow of 80, then the stock would still only produce a 10% compounded annual growth rate, which is a market average return. So for Palantir to just match the S&P 500, this is the level of growth that the business needs to see. So for Palantir to outperform the market over the next 5 years, it would need to do even better than 50% annual growth and maintain an even higher price multiple than 80. And don't get me wrong, Palantir could achieve this. You know, the business is currently accelerating. They're currently seeing 60% growth rates, but they have to maintain that level of growth over the next 5 years just to justify the price today and see a market beating return. And that's something that I'm not willing to bet on because when you have that much future growth priced in, let's say Palantir grows 35% annually over the next 5 years, which is still fantastic. Well, in that scenario, the stock would massively underperform the S&P 500 and potentially even lose money. And that's even with the business growing very well. So just based on my own portfolio and what I want to do with my investments, I don't like buying stocks that have this much future growth priced into them because I think it opens the door for things to go wrong or unforeseen circumstances to potentially affect the business. And if that happens, then, you're probably going to end up losing money or not produce very high returns. The risk reward just isn't there at prices like this. That's all I'm trying to say. And that's really my thoughts on Palantir. Fantastic results, but the stock is extremely, extremely expensive. And that is why it is selling off today. I think the market may finally be trying to focus on valuation once again. And there you have it. So moving on to the final section of this video, I want to talk about Michael Burry's new short position because he kind of came out of the woodwork and announced that he is shorting Palantir and NVIDIA. And what's interesting about this is Michael Burry, for those of you who may not know, he's the guy who did the big short. He shorted the financial crisis of 2008 and made a lot of money for him and his investors. But he doesn't always post all of the time. And he comes back to X every once in a while, deactivates his accounts. But he came back to X, basically said he thinks we're in an AI bubble, and then announced and shared his portfolio that he is shorting Palantir and NVIDIA. And he released his portfolio before he was required to by the SEC laws or whatever it is, with their disclosure laws for managers. So he announced that he has a short position on Palantir and NVIDIA the day Palantir reports and before he even had to announce it, which is kind of fishy on its own. Then Michael Burry also shared 3 images on his X account, which I have screenshotted right here. So I want to show you the 3 images that he shared. This first one is the cloud segment year-over-year growth, average growth rates across 2 key periods. So the black bars are the hyperscalers' cloud growth rates from 2018 to 2022, then from 2023 to 2025. And we can clearly see that the hyperscalers' cloud growth rates were significantly higher during the 2018 to 2022 period. And then since then, their growth rates have actually been slowing down. This next chart says US tech capex growth is matching that of the tech bubble from 1999 to 2000. So this chart is saying that the US tech stock capex growth rates are now matching the tech bubble, and that this could be suggesting that they're plowing a lot of money into trying to capitalize on this next revolution and potentially overbuilding or overspending on this AI sector. What I also think Michael Burry is trying to point out by sharing this image is that these hyperscalers are spending more and more money on capital expenditures, but the growth rates to their cloud computing segments are actually lower than they were from 2018 to 2022. So these companies are spending an ever increasing amount of money, but this investment is not resulting in even more growth. In fact, it is resulting in a deceleration of growth. And I think Michael Burry might be trying to share that this ultimately means that the return on investments of all of this massive capex spend may not be that high, or potentially a waste of money. Then the final screenshot says how NVIDIA and OpenAI fuel the AI machine. And it shows how there's this kind of circular economy going on between NVIDIA, Oracle, AMD, Intel, and really all of the AI companies. And I have seen this image being shared around before, and it seems like the overall thesis or theory with this image is that if one of the pillars within the image, like OpenAI, for example, maybe doesn't meet its commitments or goes under or sees some weakness or cannot get more funding to, again, meet all those commitments, then it will cause this chain reaction throughout the entire circular economy where Microsoft, NVIDIA, CoreWeave, and all of the other AI stocks right now would see a serious deceleration from their fundamentals or potentially even see their fundamentals decline, which is absolutely not what the market is currently pricing in. The market is pricing in that these businesses are going to continue growing rapidly for years to come. So if anything in this cog, in this circular economy that you're seeing on your screen right now, starts to break or slow down, then it could spell trouble for investors because that is not being priced in at all right now. Personally, I'm not as worried about this whole circular economy thesis or theory because a lot of this is being fueled by actual profits. Not a lot of it is being fueled by debt. The one area that seems to be a little bit sketchy to me is OpenAI with their seemingly tens of billions of dollars of new commitments being made every single freaking day. And really, it just comes down to where is that money going to come from? And if a company like Oracle is building out a data center using debt because they have these commitments from OpenAI, and then OpenAI maybe cannot raise more money in the next few years, then that kind of leaves Oracle in a risky position. But there's not a lot of that happening in the circular economy. A lot of it is being funded by cash flows. So the worst case scenario, from my perspective, at least right now, is if one part of the cog, like OpenAI, cannot get more funding, or if their business cannot turn profitable, then maybe that one section of the cog would stop spending money on NVIDIA GPUs or on data centers, which would just cause a deceleration in growth. I think that would kind of be the risk as I see it right now. But with that being said, I want to wrap up this video by watching a clip of Alex Karp reacting to Michael Burry shorting his stock, because I think that it partly explains why Michael Burry is shorting Palantir specifically, and also what Alex Karp thinks about this entire AI bubble going on right now. So I'm going to get my headphones and then I'll play the video for you. All right, so I have the video here, so let's play it and take a quick listen.
Because there is a misunderstanding. Clearly, you look at the analysts. Most analysts, think that this stock is overpriced. You have people like Michael Burry out there shorting it. Everybody who's shorted this stock thus far has been on the losing end of it. And I'm trying to understand, just from, if you look at sort of the growth trajectory, the sales, how much of the sales, frankly, I think actually even there was a huge part coming from even existing customers, and just what the scale of this thing ultimately looks like in your mind.
Okay, there are two parts. Of course, when I hear short sellers attacking what I believe is clearly the most important software company in America, and therefore in the world in terms of our impact, simply to make money, and trying to call the AI revolution into question, where we have this anomalous numbers, 114, rule of 40, et cetera. It just is super triggering, because these people, they could pick on any company in the world. They have to pick on the one that actually helps people, that actually has made money for the average person, that is actually supporting our warfighters. Why do they have to go after us? And I'll tell you what, though, it's crazy motivating, because I'll tell you why the short sellers are constantly getting screwed by Palantir. Because every time they short us, we just are like tripling down on getting the better numbers, and part, honestly, to make them poorer. But okay, so the question of the actual power of the business and what is it worth. I mean, at the end of the day, one of the things that is actually in the book, the biography, and that I actually think you always have to ask is the person persuasive or are they right? And across all sorts of movements, political, I mean, you see this on the regressive part of the Democratic Party. We're about to probably have a complete disaster. I was born in New York. But if you actually said, do these things actually work? Everyone's like, of course I'm not going to vote for that. But instead they ask, does it work in theory? The theoreticians, you have to ask, how often have you been right? And Palantir is about pragmatic decisions that create unfair advantages for America and its allies. And on that, we've been right for almost 20 years on all major decisions, and I believe we'll be right going forward. Now, you could argue, I don't know, they're constantly but they thought Palantir was overvalued at 10. They thought it was overvalued at 20. I'm not even here saying what the valuation is. I'm just saying, find a company in the world that has a rule of 114, that has U.S. commercial growing at 121%, that aggregate growth in the U.S. is 77%, that has throwing off free cash flow in a way that's anomalous, and that is fully aligned with our customers. And you figure out the value, but they're in the business of being skeptical and being wrong, and we're in the business of giving an unfair advantage to American workers, American warfighters, and our investors.
Wow. Listen, I'm not invested in Palantir. I've made that clear. But you gotta like Alex Karp. This guy knows how to interview, okay? He does a great job. He gets me fired up pretty much every time I listen to him. I think, listen, Palantir's fundamentals speak for themselves. Alex is in charge. He's doing a great job. And you can also see that he's getting kind of emotional here whenever someone is trying to short Palantir stock, because it seems like he's almost taking it like a personal attack. Like, why are these guys wanting to short my stock when I'm trying to help civilization and Western society? Why don't they go find another stock to short? Why are they attacking me? Why are they trying to harm my business? But I don't think that's what Michael Burry is doing. And I don't think that's what a lot of short sellers are doing. I think that these guys, these short sellers, are simply looking at the valuation of Palantir and thinking that it's gotten to absolutely absurd levels. and that there is more downside risk than upside risk on the stock, not on the business, on the stock, just because of how expensive it has gotten. So they think that they can make a dollar, not because Palantir is a bad business, but because it's an expensive stock. And I think Alex Karp, you're not going to see this video. I know that, but man, it's not a personal attack. I don't think it's just they're trying to make money off of your stock being overvalued. Now, then Palantir makes the point there that people were saying Palantir was overvalued at $10, $20, etc., and he is kind of saying he doesn't even know really what the valuation is. Well, maybe he's not saying he doesn't know. He just doesn't want to talk about the valuation. I thought that was an interesting part of the interview. And I thought that he made some pretty good points there. So now let's move on to the next clip that I want to share here, which starts around 8 minutes in this interview.
Alex, we've heard a lot of talk from the likes of a Michael Burry, but more broadly about whether we're in an AI bubble, whether the economics make sense. Clearly, in the context of Palantir, they do make sense insofar as you're printing money over there. Not everybody in the AI space is printing money in the same way, and they're spending an enormous amount on chips, data centers, and the like. How do you see the broader space right now in terms of just how things are developing?
There are two subtle issues in AI. What is the addressable market, and what is the addressable market for things that work? Meaning you make more money and the quality of the money is higher. So top line and bottom line grow. Palantir, we're in the business of a part of the addressable market where it works and it can be quantifiable, either commercially or on the battlefield. So clearly, and over time, you're going to have Pareto optimality, meaning that every part of the stack is going to have to create more value than they charge. That's just obvious. And if that doesn't happen, it will be a bubble. And, I'm sorry, short sellers can't tell the difference between products that work and products that don't. But these numbers should show you that there's a part of the market that, quote you, is printing cash. And it looks like that part of the market is the part we own. There's a separate question, by the way, which I think is equally relevant. What part of the GDP?
Okay, I want to pause the video really quickly right there because Alex is making a good point that not all AI companies are the same, which I think is kind of obvious but needs to be said right now. There are companies like Palantir where they are very clearly showing that their business is making money, growing exponentially, accelerating, and producing a lot of freaking cash, $2 billion in trailing 12 months cash flow. So Palantir's business in terms of AI is actually working, but it's questionable if every single company that tries to implement artificial intelligence within their own company is actually going to see benefits and work. Maybe we'll have companies where they implement a new AI product, it increases revenues, but it doesn't increase the bottom line because maybe it needs more maintenance or more software engineering or whatever. Or there's companies that may try to implement an LLM into their business, and that's an upfront cost. But then they find that their customers don't actually want to pay for this LLM, which ultimately means that their costs have increased without any revenue increase, which means profits actually go down. And in that situation, AI is actually a harm to the business, not a benefactor. So what Alex Karp is saying here is that it's not, all AI is not on the same level. There are businesses where AI is good and it's actually growing and they're proving it in their numbers. But there's businesses where that is not the case. And then he makes the point, why aren't short sellers shorting the businesses where it's clear they don't have the economics? The AI is not helping their economics. Why are they shorting the company where it's clear that AI is benefiting our business and we have the economics to prove it? Once again, I think it's just because Michael Burry is looking at the valuations of the stock and saying it's ridiculous. The business is good, but the price is insane.
GDP growth is available for workers, what we call worker available GDP. And that's like one of the unique things about Palantir is whether it's on the battlefield, like the people writing the scripts for these very complicated operations, or building batteries or doing things on the factory floor are being enhanced by our product. And those two, it's really those two questions are going to define arguably the future of what happens in this country. Does GDP grow because of AI, which only can happen if there's Pareto optimality, or in what the way we see it, the customer pays less than the value they create, which is abnormal, not exactly equal Pareto optimality. And that it's unknown, honestly. You have this massive growth, but currently, as far as I can tell, the two companies he's shorting are the ones making all the money, which is super weird. Like the idea that chips and ontology is what you want to short is batshit crazy.
And that is why I wanted to play the video all the way to the end, because in Alex Karp's words, Michael Burry is being batshit crazy by shorting Palantir and NVIDIA which he believes are the two companies that are very clearly benefiting from the AI revolution and seeing their fundamentals in economics grow significantly from all of it. So that is Alex Karp's response to Michael Burry shorting his stock. And I think that I've explained why I think Michael Burry is shorting Palantir. So with all that being said, that is going to wrap up today's video. And if you did enjoy the video, then please remember to leave a like on it. And also, if you are interested in getting my new investment course, then remember to click the link at the top of my description, go and enter your email on my website, join my email list, so that you can get notified when my Black Friday sale is running, and so that you can save some money if you're thinking about buying my course anyways. So with that being said, thank you all so much for tuning in. I truly do appreciate it, and I hope to see you again in my next video.